This segment sponsored by Foster Financial. Welcome to Wealth Wednesday, giving you your weekly dose of financial insight with Caleb Doane, the Vice President of Foster Financial. Hello, Caleb.
Hi.
Welcome.
Thanks very much.
Yes. All right. So we're in the fourth quarter, and so we're going to talk about financial planning for the end of the year. And this is some really good stuff because I think we all need to know what to do. So what will we be discussing today?
Yeah, we'll be talking a little bit about Roth conversions. I think there's kind of a list of things that I think are helpful for people to get done by the end of the calendar year. You know, there's a lot of things that are able to get pushed until the end of the tax year, which is, of course, is, next April. But there's also a whole host of things that need to be done basically by December 31st of this year. And we're, regardless of how far it is away, I drove into work this morning and this tree kind of in our parking lot, all the leaves were already off it. So, I mean, it's just a rude awakening that I guess fall is kind of here. So
I'm not ready. I'm hanging on to summer.
Yeah, I know. Exactly.
Okay. So what's the first thing that we have to do in order to start planning?
Yeah, good question. So there's kind of a list of things. Today I'll focus on Roth conversions, and this is something that has to be done by, December 31st, the end of the calendar year. And Roth conversions are kind of a tax strategizing tool. Basically what a Roth conversion is taking money from your pre-tax retirement accounts, whether that's 401k or an IRA, whatever it might be, moving some money to a Roth account, and then you actually send a little piece to the government for taxes, kind of in that process. And so people might be wondering, okay, why would I do that if I have to send money to the government for taxes?
Yes.
And it's actually to save you taxes in the long run.
Okay.
And so we sort of do calculations for people to determine if Roth conversions make sense for them. And if it does, then we set them on a path to do that.
Okay, so who really qualifies for this type of process at the end of the year? Is it someone who is entering into retirement, or just anyone who has one of these retirement accounts and they're still working? Yeah,
it's anyone who has these retirement accounts. They look a little different depending on how old you are, how close you are to retirement. But we kind of run an analysis for everyone to determine if Roth conversions will actually save them money, because not everyone will benefit from Roth conversions. And so it's important to see, if you're somebody in that category who would.
And is this Roth conversion something that happens every year, or is this just a one-time thing and choosing the best year to do it? Yeah,
typically when we set it up for people, we like to do it for multiple years, leading up to retirement or just over the course of their career. And there's plenty of situations where it makes sense for people to do this. And so I can kind of talk about a couple of them.
Yes, please.
Some of the time people say, hey, why would I convert money right now if I think I'm in, a relatively high tax bracket, and then in retirement I'm going to be in a lower tax bracket. Hey, I'd rather pay that taxes later in retirement.
Right.
And there are some situations where that's the case. But there are also a lot of situations where if people have done a really good job saving for retirement, once you get into your 70s, the government actually starts forcing you to take money out of your retirement accounts. And those are those, required minimum distributions that we talk about. And especially if somebody has, $500,000, $1 million saved up, those required minimum distributions can be really large, and then it can actually kick you up into a higher tax bracket. And so we can sort of project it out and say, okay, based on your expected withdrawals, based on, expected growth in the account, you're actually going to be in a higher tax bracket once those required minimum distributions start. And if that's the case, then we do Roth conversions now to avoid that later.
And so if someone currently has money in their 401k and it's earning something in that, by converting it, is it just choosing if the conversion will gain them a bigger yield on their investment? Is that what it's about?
That's a great question. So you can be invested in the exact same thing in both accounts, but actually the growth on those accounts is going to be treated differently. So, let's say somebody's 2 years out from retirement, and we can kind of project that, hey, once you're in retirement, you're going to need to take out, $2,000 a month or $24,000 a year from your IRA to supplement your income. You have Social Security and other stuff, but you need to take out $2,000. That means you're going to pay taxes on $24,000 in the year that you take that out. But if today we convert $24,000 from pre-tax to Roth, you pay taxes on the 24 just like you would later, but within the next 2 or 3 years, that 24 could grow to 30, let's say. And if it grows inside the Roth account, you never pay taxes on it again. And so you can pull out now that 30 and not pay any taxes. So you only paid taxes on 24 grand. And so that's one of the strategies we use to help people.
Okay, and when the government does force someone to take out those withdrawals or those distributions, that's not something that they can actually pull from their 401k, right? That is kind of pretty much locked in. You have to roll it over to have a more accessible account. Is that correct?
So you can still take those required minimum distributions even from your 401k, but a lot of times it can be a little bit inefficient to do that. And so most of the time we do recommend people roll it into something like an IRA, and a lot of times they can have an advisor that's going to help them make sure they take out enough for those required minimum distributions. But that's another advantage of the Roth account too, is that there's no required minimum distributions. You've already paid the taxes on that money, and so the government never comes asking for more, which is a nice feature.
That is kind of give you that peace of mind that you already have it settled. So how much would you recommend people converting each year into this Roth?
Yeah, so everyone's going to be a little bit different. One of the analysis that we do is we'll basically take a look at your current tax bracket, and we'll say, hey, right now you're in the 22% tax bracket. In retirement, you're projected to be in the 28% tax bracket, let's say. And we can actually look and say, okay, you have, $30,000 of room in your tax bracket before you hit the next one. And so we'll convert $30,000. That way the amount of money that we're converting keeps you in the same tax bracket, and you get to pay it in that lower tax bracket than in the higher one later. And the other thing for people to consider is that there were tax cuts in 2017, okay? So it shifted the tax brackets down. Unless new legislation is passed, those tax brackets are gonna snap back up at the end of 2025. So basically January 1st, 2026, almost everyone is gonna be in a higher tax bracket unless, new legislation is passed, which, iffy on whether that will happen.
So crazy. It's like inflation up, tax bracket up.
Right, I know, you're getting hit with everything.
I know. Okay, well, thank you, Caleb. I'm excited for us to continue on each Wealth Wednesday to find out the next step to prepare for the end of the year. Thank you.
Yeah.
And Foster Financial can actually help you break down current events and also provide you with holistic financial planning. You can give them a call today. We'll list their number below, and we'll be right back. This segment sponsored by Foster Financial.